Okay, welcome everyone. My dashboard indicates we have 36 participants so far. There's additional people coming in, but perhaps we will get started. Thanks for joining us this evening. This is the first presentation in the Argyle Fall webinar series. The topic of tonight's webinar is buying or selling dental practices in the COVID-19 era, new realities. My name is Will Hims. I am the Chief Operating Officer at Argyle Associates, and I'm going to be the moderator for tonight's discussion. We are very fortunate to have two very experienced experts as our panelists. The first is Harold Fetter. Harold is a partner in the law firm of Brazos Seller Law. He's a corporate lawyer and has done a significant amount of work over the years for various members of the Ottawa dental community. Our other panelist is Dr. Bernie Delansky, who is likely no stranger to most of you on this call. Bernie is the Senior National Partner, Transition Consultant, and Sales Representative for Tier 3 Brokerage Limited. Bernie has had a very distinguished dental career as an endodontist and is the past president of the Ottawa Dental Society. In preparation for the webinar tonight, I had a brief discussion with Harold and Bernie yesterday, and they both indicated that they could speak for hours on this topic. However, the webinar is only scheduled for an hour. They haven't prepared a formal presentation since tonight's format will be a panel discussion. They wanted me to emphasize to everybody in the call that their goal is really to answer your questions. They want to discuss whatever topics that are important to you. So I encourage you to use the chat feature. I think a lot of you have been on Zoom meetings. There's a chat feature. Send me any questions that you might have during the course of the webinar, and I'm happy as the moderator to put those questions to either Harold or Bernie as the situation sees fit. One last point before we get started. I just wanted to remind everyone that we're really looking for questions of a general nature. If you have any specific questions about your individual circumstances, Bernie and Harold have both graciously indicated that you can reach out to them by telephone or email after the webinar. They'd be more than happy to talk to you about your individual circumstances. At this end of the webinar, if I know my technology, I will post their telephone numbers and email addresses so you have that contact information. All right. So to get things started, I thought I would begin by asking a few questions. And again, I encourage people to fire additional questions. But starting with you, Harold, based on your experience over the last few months, what effect has COVID had on the dental practice market? And I thought it'd be helpful if you talked about it from the perspective of owners, buyers, the DSOs, because they become an increasingly important player in all of this. And finally, the banks, and what are we seeing in terms of finance? So over to you, Harold.
Thanks very much, Will, and thanks to all the participants. Happy to be a part of this. So, like the COVID pandemic itself, this has come somewhat in waves. The reactions of all the players, the key participants you've talked about, owners, buyers, banks, DSOs, it's gone somewhat in waves. Obviously, with the shutdown, there was tremendous uncertainty about what things were going to look like and when practices would reopen and what we would look like after reopening, what would be the impact of the PPE guidelines, et cetera, et cetera. I think everybody listening and watching knows about the uncertainty and the stress that they went through. So I think there was initially a what does all this mean type reaction and a bit of a halt. I had one practice sale during the shutdown actually get completed. And I think what happened is everybody involved, the owner, the buyer, the bank, needed to get creative. And like in most situations where there's a will, there's a way. And we came up with a holdback where essentially the vendor was funding the shortfall on expenses during the COVID shutdown out of the purchase price, and agreed to up to 10 months of funding of rent of the purchaser's financing during the shutdown. And they found a way to close. at another transaction close within a month after the practices reopened. And essentially the creativity there was the buyer and the seller came up with a threshold that once the seller got back to 85% production, the deal was solid and the buyer had to go ahead. So I think what we've seen is creativity in the early stages to get over the uncertainty. As we've come out of this, and as I think the practitioners, the professionals have come up with ways to get production back, I think people's uncertainty, the banks' jitters have been alleviated somewhat. That said, I think banks are still somewhat cautious, but willing to lend and continue to be willing to lend. And I think Bernie will get into multiples and values, but things are getting back to, if not right before COVID normal, maybe a little bit before COVID normal. So I think, you know, to summarize, it's led to creativity and ingenuity to get deals done. And I think the other thing that's happened, and I'll stop after this comment and turn it over to Bernie, is I think you've seen some fatigue in owners who may have been 5 or 10 years away before this, and that 5 or 10 year runway may have shortened to 1 to 2 or even less because of the owner fatigue and the toll that this has taken on them over these last 7-8 months. So I'll stop my comments there and maybe turn it over to Bernie to add his input.
Good evening to everybody. Thanks for your comments, Harold. And not unusually, I do agree with all of them. Although that from time to time, we've had our disagreements about things.
Yes.
In a very professional manner.
Absolutely.
Just to pick up where Harold left off about owners perhaps shortening their time horizon to transition. Pre-COVID, the main problems that I heard from colleagues, clients, was the difficulty of running a practice. And those were particularly in 2 areas. Personnel's been a challenge for a while now, getting and keeping good personnel in dental offices, and the red tape and regulations, such things as infection control, etc. With COVID, everything changed. Suddenly we had those factors still there, but the shutdown, and now getting back to work under different circumstances. In a way, everything has changed, and in a way, nothing has changed. Because, as Harold, you've alluded to, practice values, for all intents and purposes, are pretty well back to where they were, let's say, in the 3rd to 4th quarter of 2019. The 4th quarter of 2019 and 1st quarter of 2020 saw probably the most active market I've seen, and I've been doing this for 20 years. And but certainly we're back to the pre-COVID values. As a matter of fact, I can tell you, just to put this in context, Tier 3 Brokerage has closed or is closing 8 transactions, all of them after March 15th, and with the exception of 1, all of them selling at pre-COVID values, and with a range of 10 to 27% above appraised values over those 8 practices. And just to gauge demand, we've had between 6 and 26 offers on each of those practices, a low of 6 on one practice and a high of 26 on another practice, and everything in between. So the market is active. And as a matter of fact, we've been talking about the effect on owners. Again, a factoid, if you wish. Our brokerage has a registry for buyers so that when we get a listing, we can sell it to them. We can send them the listing, rather, and hopefully sell it to them. And during the months of April and May, of 2020, we had twice the number of dentists who want to buy practices register as the same months in 2019. Think about that. Twice the number of people who usually register wanting to buy a practice 1 year over the other. So associates are also increasing demand. And Will, you alluded to DSOs. They definitely paused during the shutdown, but they are very much back in the fray. And Harold, you alerted to values. Just very quickly, the way dental practices are valued now is what's called a multiple of earnings. I know as dentists, we tend to think of my practice sold for 110% of gross, 120% of gross. If it's got a problem, 80 or 90% of gross. That's not the way buyers and banks are valuing, and that's not how we as appraisers are valuing. We're valuing of a multiple of your profits, of your earnings. And how does that work? Essentially, we take your expenses, we normalize them. What that means is if you're running allowed things through your practice, an easy one is paying a spouse or family member a salary for work they're doing, we will add that back to your profits on the premise that a new buyer probably won't be paying your spouse or child a salary. I think that's a valid premise. And so we normalize for expenses like that, and then we'll take in a general practice as a benchmark 40% of the dental production as an expense. And whatever is left is then your profits, your earnings. There's a accounting firm term for it called EBITDA, earnings before interest, taxes, depreciation, and amortization. It's your cash flow. And presently in Canada, generally speaking, the range for dental practice sales is somewhere between 5 and 7 times that number. That's how practices are valued. And the multiples are pretty well back to what they were before. And I think, Harold, you mentioned a deal you did where you were able to demonstrate to the bank that the practice was back to 70% of pre-COVID production.
It was actually 85.
85. We're finding anything over 70. If it's on an upward trend and it's getting back somewhere between 70 and 100, and some are having their best months now because of catch up, the banks will finance, the buyers will close. So perhaps I'll pause there, and Will, perhaps there are some other questions that you or others have.
So I did get one question here on a valuation issue, Bernie, and the person's asking, so you're looking at a multiple of EBITDA, but we've only got a couple of months experience since the shutdown. So are they looking at pre-COVID EBITDA, and how do they adjust for that?
Great question. There are a couple of ways we've been doing it. And by the way, we've been literally doing dozens of valuations right through COVID and presently. Because like Harold said, a lot of owners are starting to think about it.
Right.
And we've been doing literally dozens of valuations during this period. Up until last month, what we were doing was valuing till February 29th, the last full month before the shutdown, and using that 12 months. And then if it went to market, the test was somewhere around 70 to 80% recoup of production revenues, and hopefully that would be reflected in EBITDA. But what we're doing now, and have been doing for the past few weeks, is we're actually doing the past 12 months, and for March, from March 1st until June 1st, when people went back to work, we've been using the 2019 numbers. And again, if we can demonstrate that those numbers are being matched again going forward, we're having no trouble selling at all. Multiple offers and multiple offers over appraised value.
I think just to add from the bank's perspective, they want to see the post-COVID track record. And once they see that for multiple months, they're willing to accept, I think, pre-COVID EBITDA as being a solid benchmark. I had one situation, a substantial practice, where initially the bank was only going to fund a 75% purchase because they wanted more time to watch the owner bring it back. Over the period of the negotiations and the discussions, production kept going and climbed pretty rapidly. So within a couple of months, the bank reconsidered and committed to funding a 100% purchase, whereas a month or two earlier, they were a bit skittish and wanted the owner to stay in and wanted a longer period of time to watch the production come back. So I would echo Bernie's comments. I think once they see month over month over month production returning to pre-COVID levels, they're willing to accept pre-COVID EBITDA.
So Bernie, we've had another question where people are asking, based on your comments, it seems to be still very much a seller's market. The person's asking, what is the average length of time on the market that passes before a practice sells?
For a good general practice, and let me define that somewhat, a general practice that has a good breakdown between hygiene and dentistry and has no issues, okay? The lease is good, or the premises are available. There are no great hindrances to sell. And Harold, you can comment from the lawyer's point of view. The selling process is it takes 3 to 4 weeks to do evaluation from the time we have all the information, and then discussion, finalize the valuation, put it on the market. In most areas of the country where demand is good, seller's market, that is another 4 to 6 week process to show the practice, get in the LOIs, letters of intent, offers, and sort through them, negotiate, have the buyer and their team do the due diligence, make sure that everything is to their satisfaction, have the lawyers do their work. Usually the selling process is somewhere between a 4 and 6 month process. The actual time on the market for general practices, from the time we put it out there to the time you're looking at offers, tends to be between 4 and 6 weeks.
Okay. Harold, anything to add?
Yeah, so once we get involved at the lawyer stage, it's typically after the vendor together with their broker have reviewed all the LOIs and chosen the one they want to pursue. That next stage from accepted LOI to signed purchase agreement to closing, I would say is anywhere from a month to maybe 2 to 3 months, and really driven by the purchaser and how eager they want to get in there and complete the transaction, and also how solid the covenant is, the size of the practice, and that'll impact on how long it takes to work with the bank. And I think the other factor that is very important to keep in mind is how long does the vendor have where they want to stay practicing. The shorter that period, the quicker you're going to want to get to a close and take advantage to, as long as possible, a period post-closing where the vendor is still involved in the practice. If you're getting a couple of years out of the vendor, you don't have necessarily that same urgency to close as quickly as possible. So there's a number of moving parts, but I would say 1 to 3 months from the time it gets into a lawyer's hands to start drafting the purchase agreement and related documents until we have a close.
Yeah, no slur on any lawyer, but 1 month is warp speed in lawyer land.
We've done it, as you know.
It's hard work being a lawyer, Bernie.
Well, if I could add something about one segment of the market, getting back to your question about what has changed. What's interesting is what's happened with the DSOs. The larger DSOs during the shutdown really suffered. They're very, very large concerns, a lot of financing involved. And of course, just like the single practice owner, they had no cash flow. But it's interesting, they actually pay more for their financing than the single buyer does. Single buyers of dental practices in Canada are truly unique. It's actually, and many bankers have told me this, the only small business in Canada that they're interested in financing and gets 100% financing at prime and in the odd case below prime. It's really, really unique. DSOs pay more for their money. And the other thing that has changed is pre-COVID, in order to get top dollar, i.e. top multiple from a DSO, in many cases you had to give an earning guarantee. Markets hate uncertainty. And so far we've beaten that uncertainty in dentistry. But I would be very, very leery and uncertain about giving an earnings guarantee going forward in the environment we're in, with the risk of another shutdown, etc. I did one of these webinars 3 weeks ago with a well-known dental financial consultant, and he was advising his clients that if they were intending to sell in the next 2 to 5 years, he didn't like the uncertainty. He was advising his clients to sell because of uncertainty. And I would be really leery about giving a earnings guarantee in this environment.
So
To
overall,
pick up on-
Bernie,
I was just sorry. Well,
Yeah,
I was just going to pick up on the earnings guarantee concept. Everything has a price. So if a vendor absolutely refused to give a earnings guarantee for the reasons Bernie cited, the DSOs may still talk, but there'll be an impact on your earnings multiple. The price comes down because they are picking up the uncertainty. And when we're talking about DSOs, I think the other trend that I've seen really in the last year, and I don't know that it's necessarily COVID related, I think it's just sophistication, and as more people are aware of the DSOs out there, what I was seeing a while ago would be there'd be a connection through a referral, whatever. They would know the business development person for a particular DSO. They would get an offer, they would like it, and they would proceed. Now, no vendor makes a move with it without at least 2, if not 3 letters of intent from the DSOs, and they talk to 2, 3, 4, whatever it is, before making up their mind. And they're also not necessarily down the DSO track or the broker track or to their associate track. They're becoming more sophisticated, and I think looking at all options. And that really is quite a recent trend, at least in terms of what I've seen.
Agreed.
So, Harold and Bernie, a question that has often been put to me, and I know neither of you have a crystal ball, but I suspect a lot of the people on this call are thinking, if they're an associate looking to buy, or they're a dentist nearing the end of their career, is now the time to buy or sell, or should I really just wait, at least a year or 2 and wait for COVID to pass, and maybe the overall environment will actually improve and I could do better once COVID has indeed passed? What are your thoughts? Starting with you, Bernie.
If you'd asked me that question a month ago, I would have been fairly uncertain about my answer. But given what I've mentioned earlier about the practices we're selling, all the pre-COVID prices, I really can't see prices going much higher. And let me explain why. The ceiling on prices is really related to that multiple that I talked about. If you think about it, a multiple of 6 times earnings basically means a return on investment of 16%. Multiple of 5 times earnings is a return of 20%. There's a floor to the earnings that an investor wants. And the large DSOs with their very large venture capital investors are not going to go much higher, I don't think, than 7 times earnings, in exceptional circumstances, 8 times earnings. Their own enterprises pre-COVID were being valued at 12 to 14 times earnings. That's what they were selling their own equity at. And they need that much margin. So given that floor or ceiling, depending whether you're looking up or down, maybe Harold has a different opinion, but I can't see you getting more for your practice a year or 2 from now. As I said, a month earlier, I would have said the uncertainty probably is going to have effect on prices, but I've got data points now. I've got practices we've sold, and they're selling at over appraised value based on pre-COVID appraisals.
Harold, your thoughts?
Yeah, so I guess the first thing I would say is maybe ignoring the valuation issue. And Bernie's heard me say this a number of times, probably will, you've heard it as well, that the sale of a dental practice will likely be the worst financial decision that a dentist will make. And I say that not because you won't make a lot of money selling your dental practice, it's that the profitability of a dental practice will be likely unmatched in anything you're going to do with your sale proceeds. So leaving aside health issues, owner fatigue issues, and the like, to the extent that you're still enjoying the practice of dentistry, I don't see a push to sell, because from a purely monetary standpoint, you're not going to match those profits. If any of those other factors come in, I tend to agree with Bernie. It's hard to see the ceiling go a lot higher, but I think the reality is we probably could have said that, and I could recall conversations with Bernie years ago where we talked about how hot the market is and influences, and can it keep going, can it keep going? I mean, I think what would have to happen, because I think that the DSOs in many respects set the the limit, and the only way it could keep going is if their profitability and what they're able to value their package of multiple dental offices at, if it goes up beyond 12 to 14 and reaches the higher end, then there's a little bit more margin to move up the EBITDA multiples for the individual practices. But at some point you do reach the ceiling. So it's hard to say it could go a whole lot higher. But I go back to the point, if it ain't broke, don't fix it. If you're enjoying yourself and you can keep going, a year or 2 years from now, I don't see it dropping. So I don't think that would be an issue. We don't have a crystal ball, and obviously the impact of COVID is completely uncertain. And if we have another shutdown, then obviously selling during that shutdown. But I think this past year's experience about how quickly things bounce back post shutdown in terms of production and in turn in terms of values, I think that's a pretty solid indication that if we face another shutdown, we could expect a similar return to production and values once it reopens.
I agree with Harold. The corollary to what Harold said, that selling your practice is probably the worst financial decision you can make, is that if you do it, it's probably the best lifestyle decision you can make. And that's the only reason for doing it, is a lifestyle decision. Um, and what I wanted to add to my remarks about DSOs is that what Harold says about more people dealing with several of them is all the stuff, and by stuff I mean conditions, not just price, but conditions like earnings guarantees, how long you stay, how much you have to work, et cetera, that's all negotiable. But you have to know how to negotiate, what's possible, and to be blunt, how to play them off against each other.
So Bernie, I was speaking to a well-known US-based dental consultant named Roger Levine, and he's been very active and does a lot of webinars. And Roger tells me that there's a little bit of an artificial optimism right now. He feels that a lot of dental practices are firing on all cylinders. Their production might even be higher than pre-COVID, but he feels that's temporary. That's a lot of just the pent-up demand. That fairly soon things are going to start to level off, and we're probably going to be producing at 70–80% of where we were pre-COVID. And if that happens, I would think that if I'm a young associate looking to buy a dental practice and we're just working through the pent-up demand and things are going to start to level off, maybe it might be better just to wait a little bit longer and see whether indeed this is a little bit of a bubble and things are going to come down. But you feel, Bernie, that's not the case. So your thoughts, Bernie?
I know Roger, by the way, and actually worked with him several years ago. He's very, very knowledgeable, but he's also US based.
Sure.
And the US market for dental practices is very, very different than the Canadian one. Firstly, it's very regional. In some some regions of the US, dental practices are hardly worth anything. In other regions of the US, they're more like Canada. It's very regional. And what drives that regionality is what's driving the market in Canada. And to be blunt, it's the fact that you have, firstly, too many dentists and not enough patients. So essentially, the value in the dental practice and a general dental practice, specialty practices are different. In the general dental practice, we know from experience of selling literally thousands of dental practices that you can transfer that patient base and that revenue derived from it quite reliably. So as long as we have too many dentists in Canada, plus the second factor, too many dollars chasing dental practices, there are literally billions with a B of investment dollars just in Canada, not let alone the States, just in Canada, trying to buy dental practices. Just this week, yesterday, I had a call from an investor, an accountant in Quebec, representing a group of investors who had given him a mandate to buy 20 dental practices in the next 12 months.
Wow.
And my comment to him was, good luck. But that's just an example. And we get these calls or requests for meetings with investors on a pretty regular basis. And as long as we have those two things, too many dentists and too many dollars, I can't see demand dropping. And the ultimate price of anything is determined by supply and demand. I just don't see that changing over the next 2 to 3 years.
Harold, your thoughts?
So I noticed there was a question in the chat as well about whether the flip side is true about associates waiting. So the interesting thing about what's gone on during this, and this is the impact on the buyers and on associates, as work maybe dries up, and to your point, Will, if you see a scale back in production once this pent-up demand levels off, who's going to suffer? The owner is going to keep working. So the individuals that suffer are the associates. They're the ones that are going to get the short end of the stick in terms of
Good point.
going back to work. So the only way for associates to control how much work they have is to own a practice. So I think that's driving and incentivizing associates who have gone through this, where they're having a harder time finding work, to incentivize them to look to buy a practice, so that they control their destiny. I think the other thing is, you know, the flip side to my comment that the worst financial decision you can make is to sell your practice. I think the best financial decision you could make is to buy a practice sooner rather than later, if you can. Now, of course, nobody wants to start a new business and have a government mandated shutdown and no cash flow. Obviously, that's problematic. But in the ordinary course, dental practices are incredibly profitable. And when you own them and you own the hygiene component of the dental practice, it's a very, very profitable business. So all things being equal, ownership of a dental practice is a very good financial decision. And I think what has happened in the last number of months is that associates have felt very vulnerable, and as a result are looking to control their fate. The other thing I would add that I think is a factor in the market, as prices went up, there was a trend for associates to start their own practices, and because people felt that they could fit up a brand new space, get all the equipment of their choice, design of their choice, and maybe if they had an associate position or a couple of associate positions, they could continue a revenue stream as they started part-time in their new premises and build up a practice. I know Bernie and I have worked together on a deal where an owner started up a new practice in a rural area outside of Ottawa, built it up with an associate within a couple of years, and sold it for just under $2 million. So from zero to just under $2 million in a couple of years is incredible growth. Now, the point I was going to make is in the COVID era and the impact on construction. So you had a shutdown for a long period of time, and now you have pent up demand with construction resources, materials, building permits. I'm seeing that a number of associates that look to the lease and fit up and start your own practice, I've seen a number of associates experiencing significant delays of a year plus before they're going to be ready to open. And obviously that's a tough hit. So I think anyone considering that approach, they need to be mindful of where they're looking and the impact of construction delays, both on the landlord side and their own tenants' work side.
Okay, Harold, so we've had a number of questions come in. Maybe you could take a stab at this first one, which is, Bernie had mentioned hygiene mix is an important factor in determining valuation. What other factors define a good general practice and command higher values?
Okay. Hygiene in Ontario and most of the other provinces, with the exception of Quebec, is by far the most profitable part of a general practice for an investor. And for better or worse, it's the investors that are driving the pricing of the market. And very quickly, the reason for that is you're going to pay a hygienist somewhere between $35 and $50 an hour to hopefully produce somewhere between $150 to $200 an hour. The average we see is $150. If you're going to have an associate working for you, producing $150 an hour, you're going to have to pay them 40%, which is $60. Also, hygiene supplies run at 1 to 2% of revenue, and dental supplies run somewhere between 8 and 9% of revenue. So just those numbers will show you why hygiene is the most profitable part of a practice. It's also the most transferable part of the practice, as long as you're not stupid enough to fire the hygienist after you buy the practice.
So, but Bernie, but apart from hygiene, and you've indicated it is the most important factor, what other factors influence valuations?
Okay, here are the three big expenses in a dental practice. By far the largest, staff. If your staff expenses, after you normalize for family and other salaries like that, should be somewhere, now I'm giving you Ontario numbers, somewhere around 27 to 28% of your revenue.
Right.
If it's higher, it's going to impact that bottom line. If it's lower, it's going to impact it in a good way. The next largest expense are dental supplies. Now, with the increased PPE, I don't have figures for that, but prior to COVID, we were looking at 7 to 8%. I imagine that's gone up now, but there is the ability to pass that on to patients as a surcharge. Some offices are doing it, some are not, but that's your next highest one. And your third highest one is rent, which again, let's talk about Southern Ontario, should be running somewhere around 5 or 6%. If those costs are in line and you don't have any other extraordinary costs, then you're going to have a profitable practice with somewhere around an average EBITDA. So those are the main factors.
I'll just pick up on, the other thing I would add just from the legal side, and this isn't an expense issue, it's an uncertainty and a potential future expense in terms of how solid your employment contracts are and the impact on possible termination. So where you've got a long-standing practice without any written employment contracts, and just to clarify, every time you have an employee, there is an employment contract. It just may be oral. So we're talking about written employment contracts with well-defined termination provisions. If you've got that in place, that's a big risk factor that a buyer does not have to worry about. If you don't, then it is a big risk factor. And what a buyer is weighing is if you have a very senior staff person who may want to hang on beyond their maximum productivity levels, and you want to dismiss them without a written employment contract containing sensible termination provisions, that could be a huge cost of up to 2 times their annual salary. And so if a purchaser is looking at a staff where those risk factors are present, it will have an impact on the purchase price, and even sometimes on whether a deal will be made. Bernie will recall an early transaction that we were on where the vendor had this issue, and the deal died until the lawyers involved were able to work out a sharing of that risk to throw a little bit of fuel on the almost dying embers and resurrect the deal. But it is a significant issue, and we've all seen deals die because of these risk factors.
Harold, would you comment on something I've heard, which I think could be a great benefit to the people listening in? I heard there was a recent decision affecting employment contracts. I believe it's called the Waxdale decision, where many employment contracts that were valid up until June of this year are no longer valid.
So Harold, a great question, Bernie, and keep your comments fairly brief, Harold, because that's the topic of our next webinar on October 28th.
Oh, okay.
Colleen Dunlap, a partner at the law firm of Eamon Harding, is going to talk on that issue, among others, COVID-related issues. But nonetheless, Harold, just quickly an overview, because for the members on this call, there is this Ontario Court of Appeal decision, which has effectively rendered most employment agreements null and void.
Well, at least the termination provisions.
Termination provision.
Yeah.
Which
So
is
the contract,
in terms of valuation.
yes, the contract is still valid, but it has created tremendous uncertainty in the validity of employment contracts. So I think the bottom line, I'm not an employment law specialist. I've learned a lot at the feet of the employment law specialists in my firm who work with me and my dental practice clients. So I'm not an expert, but all I would say is speak to an expert. If you've had employment contracts in place more than a year ago or so, you should revisit them and make sure you, at the very least, know where you stand with your employment lawyer and whether they're recommending amending those agreements. And if any of you have gone through it, the implementation of employment contracts within the duration of the employment relationship is a delicate balance and needs professional advice in order to be handled properly. I'll leave it there, and I don't want to steal your thunder and Colleen's thunder at your next seminar.
Sounds good. So Bernie, the next question that we received was a two-part question, and you had mentioned the growing supply of dentists in the market. So the person's asking, with more grads coming into the market, are we likely to see a decline in the short term or in medium term of valuations with new grads entering the market?
I think what we have seen over the last several years, and this is a phenomenon that has gone on for at least 5 years. And by the way, it's being driven mostly by the numbers in Ontario, somewhat in BC, much less in the rest of the country. But what we've seen is it's had the opposite effect. It's had the effect that I mentioned earlier. It's made a patient chart more valuable. Too many dentists, not enough patients. So general practices that, let's say, have north of 1,000, 1,200, 1,500 patients that have been coming to that practice for a number of years reliably will only get more valuable. The people that are doing well with new startups are doing so usually in areas of the city that have new housing and you have a chance to build a practice. But to try and start a practice in established parts of the city is quite difficult financially and in every other way. So my answer is no, I don't see that happening.
And the second part of the question, Bernie, is the bank's appetite for financing new practice, particularly startups. The person asking the question has heard that the big 5 banks have placed a moratorium on financing startups. What has your experience been?
I don't deal with startups, so I'm not an expert on that. But I very briefly can tell you that there have been more rumors about the banks over the last 4 months than I've seen over the last 20 years. Okay. And when we check them out, because we're not doing our jobs as brokers if we don't have good, steady communication with the bankers. When we speak to the people in charge at the banks, they've all said, we love this market, we're still interested in it, but Harold, maybe you have some more immediate banking experience with startups. As I say, I don't do them.
Yeah, so I haven't heard anything about a moratorium, but banks finance cash flow, and where there's existing cash flow, they trip over themselves to fund. Where there's not, they're obviously weighing risk. So I haven't heard it's a moratorium, but I think they look at market factors. I think they would look to, and there was another question about whether rural markets are, are more popular now. So I think where there's a business case to be made for a developing area, a new, new subdivision, or where servicing has gone out beyond the city limits, I think in those areas it would be more attractive. But I think that in those circumstances, I think typically the associate or the person doing the startup has to do some of their own financing through other means.
Okay. So interesting question, Harold. You mentioned that one of the factors that influences the valuation is to whether the practice has all the employees on employment contracts, because if they don't, there are potential expenses with respect to terminations. So the person's asking, in your experience, Harold, how many of the practices that you are involved in terms of the sale, do they have all the employees on employment agreements?
Well, if they're If they're my clients, then it's 100%. If they've come to me as a referral for the sale, I would say, maybe 50-50. It seems to me that some of the older practitioners may not have ever had occasion to revisit this. I think 20-30 years ago, it probably wasn't the norm. I think payouts on termination weren't the same. And when you were starting out, you didn't have to worry about the payouts on termination because all your staff was new. So I think what I've seen is those who have been at it for 30 plus years, they're the ones who typically need that advice and needed to have that looked at in order to maybe get out of the inertia. So I would say the ones that I get, new just to sell are probably in the 50-50, but it's rising. I think the number of people that have heard about this as a significant risk factor on the sale of a practice is rising, and I think that percentage is climbing in terms of those that do have proper employment contracts in place. And going back to the Court of Appeal decision, this is something that's going to have to be revisited in terms of the validity of the termination provisions.
So, Harold, on that Court of Appeal decision, my partners were asking, what about an appeal to the Supreme Court? Is there any update there? Is that decision likely to go to the Supreme Court?
I haven't heard, but I can just tell you from what I've heard from our own employment people, they think that the decision was wrongly decided. Now, not all wrongly decided decisions at the Court of Appeal level get to the Supreme Court. There needs to be, as some sort of national import. I think you can make the case that this does, but I have not heard. But all I can tell you is that the preponderance opinion is it was wrongly decided.
Interesting.
Okay, well, just getting back to that question about employment contracts percentage of practices, we evaluate up to 200 practices a year. And I would say we've probably surpassed 50% now have contracts. And as Harold says, that number is definitely going up. People are becoming more aware of the importance of it.
Yeah.
So Bernie, we had another question. If you could just recap again, what are the 3 biggest expenses in a dental practice and what are the industry benchmarks?
Again, Ontario averages, personnel, staff should be somewhere around 27 to 28%. Supplies, before the PPE factor came in, we should be running around 8%, and rent should be running between 5 and 7%.
I just want to make a quick comment on rent, because I see this very, very often among dental practitioners. The revenue that's generated per square foot in dental offices is relatively high. I haven't done the survey, but I know what type of revenue dental offices can generate from 1,000, 1,200, 1,500 square feet is very, very significant. I think it goes back to also how profitable dental offices are as a business. So with that in mind, I see very often where the dental professional as a tenant gets very hung up by percentage increases, and I think risks affecting the relationship with the landlord over what at the end of the day is not a huge impact on the bottom line. If you look at an example, and I'll use simple math, if it's 1,000 square feet and the landlord's proposing going from $20 to $25 a square foot, year over year, that's a 25% increase. It sounds huge. 5 times 1,000 is $5,000 on the bottom line. Not a huge amount. I'm not saying you roll over and concede, but I think it's important with rent to keep it in perspective and to recognize the value of the relationship with the landlord and maybe trade off on certain things, particularly if you're approaching the period of time where you want to consider a sale and start to think about other provisions that may impact on your ability to sell, and specifically, the assignment of lease clause and what the consent provisions look like and what the landlord's rights are to block an assignment. I think those factors can be much more important than the bottom line on rent. So it's just a word of caution to keep, the rent discussions in perspective, and to not focus on percentages, but think about the impact on the bottom line and whether there are other elements to the lease which may be more important.
So Harold and Bernie, we're just coming up to 8 o'clock. I think we have time for one last question. And the person's asking, what is the ideal time a vendor should stay on after purchasing a practice? Any thoughts?
Generally speaking, the answer would be as long as possible. The minimum that I tell my clients is 6 months in order to do at least some transition. 9 to 12 months is better, because then you're getting into a complete recall cycle. Now, the difference is it an individual buyer? If you have an individual buyer buying a three-chair practice, both of you working is a challenge. So remember, staying on in many cases means part-time. It may be a day to 2 days to 2.5 days spread out over a week. It's not working 4 or 5 days a week, generally speaking. On the other hand, if it's an investor, you're going to get the most money with the fewest conditions the longer you can stay. If you can stay, many of them ask for 5 years. In negotiation, the minimum they'll take is 3. But again, if you're the owner of a practice where the majority of the work is already being done by associates, you're in a bit different situation than if you're doing the majority or all of the work. So within those variables, those are the time factors.
Harold, anything you add?
Yeah, the only thing I would add is, and we've made this point, I think, over and over again, everything has a price. So if you want to maximize the value as a vendor, the longer you stay, the more you're going to get for your practice. You're taking away some of the risk on the purchaser, and certainly, like Bernie said, the DSOs are looking for 5+ years because they want a repeat of the recall cycles, and they want to make sure they have maximum retention. If you're a vendor that's just done, whether it's physically, mentally, a combination of both, and you're not willing to put in the 6 months, that'll have an impact on your purchase price, on your earnings multiples that you're going to be able to get. And I think can't overstate this, the importance of the relationship in that transition, and the vendor accepting that they are becoming an associate, and maintaining a good relationship with the purchaser. I think that's very, very important. And as a result of that, I think sometimes who you sell to, even if it may be not necessarily the highest bidder in the LOIs, can be an important non-monetary decision that can really improve the satisfaction. And we said this earlier too, it's a lifestyle choice. And I think if you find the right purchaser for your patients and your staff, it's hard to put a monetary value on that. And that's, I think, something that's also very important to keep in mind. And in turn, obviously that plays into how long you're going to want to stick around.
All right.
Just to put what we've been saying in perspective, both Harold and I have been talking about general practices. If there are any specialists on this webinar, you're in a very different situation. You're going to have to stay a minimum of 1.5 to 2 years, because you're not transferring a patient base, you're transferring a referral base. And that's a whole different thing if you want to call it that. So just put that in context.
Good point.
Okay, well, a very big thank you to Bernie and Harold. Lots of very good information. As I mentioned at the beginning of the webinar, I'm going to do a share screen right now, and I'm going to give you the coordinates for Harold and Bernie. They, as I mentioned, they have very kindly offered to answer any questions that anyone might have about their own individual circumstances or practices. So if I can do this right, I share my screen here. Okay. Right now I'm on full screen mode. I need my IT person here because I can't seem to get out of full screen mode. I had the information. Most of you have responded by email, so send me a quick email. You can certainly find Harold simply by just Googling and Bernie as well at Tier 3 and Brazos Cellular Law. Just a reminder, as I mentioned in the earlier in the webinar, our next topic is on employment law issues with respect to COVID. We have Colleen Dunlap at the law firm of Edmund Harden and one of her associates. We've had already lots of interest. We will be sending out another email blast with the Zoom coordinates. And then my last comment to everybody in the call is we're hoping to do 1 or 2 more webinars as part of this series. So if you have any suggestions for topics, any areas that you would like us to address, please reach out. Always like the feedback. And so thank you again, Bernie, Harold, everybody in the call. Have a great evening. Hope you found this helpful.
Thanks, Will. Thanks for the opportunity. Great talking to everybody.
Thank you, everybody. Good night.
Good night, all.